Good morning and Happy New Year. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today, January 6, 2025. Of course, you can follow me intra-week if I've got something to say on LinkedIn, Herb Morgan, or on Twitter or X at Herb W. Morgan. This presentation has been created by me for use with you. Whether you are a financial advisor or an individual investor, it doesn't matter. You're still expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment, tax advice, recommendation for the purchase or sale of any securities. Everything is strictly for informational purposes only. The views expressed herein are mine and mine alone. They may differ from the views of CFIA's parent affiliates or other portfolio managers here at the firm. Well, our first week of trading for 2025, it actually was partially 2024, was mixed. S&P 500 down about 0.5%, but mid and small cap stocks continue to rally, the Santa Claus rally that they've been engaged in for a couple of months. But international markets declined. On a year-to-date basis, was just a couple of days, though, we had nice rallies across the board, the exception there being large cap international down about 0.3%. Fixed income was mostly steady. High yield caught a bid. You can see high yield there up about 50 basis points on the week, 49 basis points. You can see also the merger ARB index. I don't really talk too much about the alternatives when I go through this each week because the alternatives are supposed to be, kind of uncorrelated returns, right? Sort of consistent, steady Eddie returns. And alternatives have done fine the last few years for us, but we look at competitors being short-term treasuries, right? Those are absolute return vehicles. And merger ARB has been sort of hindered by government view of merger ARB and transactions that has been slow. Many deals have not gotten approved, and it's sort of hurt the performance of the asset class. With the new administration coming in, we expect mergers and acquisitions to pick up in 2025, and we expect better returns. We had good returns, but we expect even better returns going forward. It was a shortened week because of the New Year's holiday, but we still got plenty of economic data to talk about. Let's start with manufacturing. We got manufacturing data from S&P Global, ISM, and then the regional MNI Chicago Business Barometer. The Chicago PMI fell to 36.9. You can see that over on the right-hand side of the chart. That's pretty darn low. So we still have this manufacturing recession going on. Keep in mind, manufacturing is about 15% of the U.S. economy. Service sector is about 85%. You can see here new orders fell considerably. Anything below 50 is contraction, so it accelerated the rate of decline. Production accelerated the rate of decline. Employment, however, the decline seemed to slow down. 49.4 is close enough to 50. Then we got the national readings, and as you know, national is bigger. Fell a little bit from 49.7 to 49.4, but was above expectations. This is S&P Global's reading, and here we are getting really close to coming back to getting to an expansive run of manufacturing. You can see, though, from the most part, starting here in around 2022, manufacturing has been in decline. A couple of months of expansion here earlier this year, and then we're getting close again at the moment. ISM, Institute for Supply Management's reading of manufacturing, also for the month of December, came in really close to that 50 line. You can see 49.3 above the estimate. New orders, which suggests a manufacturing pickup in the future, which expanded in November, expanded again and at a little faster pace, and production actually expanded 50.3, barely. Employment here, however, clicked down a little bit. So it's still mixed data on manufacturing, but with expectations for the new year, capital availability, policy, etc., we expect manufacturing probably to recover maybe later in 2025. Let's move on to residential real estate. That's something that's important to all of us. It's a big part of our balance sheets if we own a home. Pending home sales gained 2%. The estimate was much lower and are up about 5.6, which is below the estimate from a year ago. This is surprising that residential real estate is doing as well as it is. It's not doing great, but given the fact that the Fed started cutting short-term interest rates in September and mortgage rates actually have gone up almost 1 full percent or 100 basis points since that time, suggests to me that the industry is still struggling, but we got a pending home sales gain of 2.2% last month. FHFA House Price Index for October. Remember, this data is kind of late to get to us because it's home sales. The data has to be collected and distributed. House price is up 0.4% and up 4.5% on a year-over-year basis. Similar kind of reading here from Case-Shiller. Case-Shiller says in October, home prices rose 0.3%, and they're up also a little over 4% on a year-over-year basis. I think one of the best real-time indicators of what's happening in the economy, leading indicator to tell me where things are going, is initial weekly claims for unemployment. The initial weekly claims for unemployment comes out every Thursday, 5 a.m. Pacific time, which is my time. Very low 200,000s, fell from 220 to 211 last week. Continuing claims well below that 2 million number, 1.844. And as a percentage of the labor force, you've heard me say this before, lower than it's ever been. And even just absolute numbers, comparing it to a labor force that was much smaller in, say, the 1960s, we're at a level that we were at in 1967. So I think the recession talk is all but over at this point. It would take some sort of an exogenous shock, like a COVID pandemic or a global financial crisis, to move things into recession. There's nothing about the cycle at this point that seems to indicate a recession is anywhere near. Construction spending for November was unchanged and is up 3% on a year-over-year basis. Residential spending was up 0.1% on a year-over-year basis. We got that report last week as well. So the last thing I want to leave you with this week is this chart. And I've showed you this chart for several, on and off for years, but in the last, say, 2 or 3 months, I've shown it to you more. And what this chart does is it takes the inverse of the PE, price to earnings ratio of the S&P 500, and instead it takes the earnings to price ratio. So it's the earnings yield, and it compares it to the yield on the 10-year U.S. Treasury. And as I mentioned, the yield on the 10-year U.S. Treasury has risen from 360 when the Fed started cutting rates to 460 now, up about 100 basis points. And so you have to, when we look to, do I want to buy stocks? Do I want to take risk? I always compare it to, well, what can I do without risk? And that's the 10-year U.S. Treasury. I can take my money, give it to the U.S. Treasury for 10 years. It's 100% guaranteed. I pay no state income taxes, and I get this nice return. And the earnings yield of the S&P is what it is. And so when this number is really high, the delta between the two, stocks have usually fallen a lot, tanked, if you will. This is obviously the global financial crisis, represented a great buying opportunity. This is the COVID crisis. You could see there represented a great buying opportunity. And yet here we are now where we're negative. So actually the risk-free yield of the 10-year Treasury is higher than the S&P 500 earnings yield. And so textbook analysis says that the market is undervalued. So you can say in all this period here, when the negative number, market is undervalued, right? This is all through the 90s, which was a great time for stock market performance. And over here, above the zero line, this is a time when the market would be considered undervalued. So I decided to take the data, go back and look. Now, keep in mind with data, it's always limited. You never have enough. And you always are sort of saying, well, this is what it did. Doesn't necessarily mean it'll do it again. So interestingly, I said, well, when the Fed model either is on a weekly basis, was either positive or negative, how did stocks do as measured by the S&P 500 6 months, a year, and 5 years later? Well, there's really no difference in the 6-month return. I would say no difference in the 1-year return, whether it's positive or negative. And look at the 5-year return. Yeah, you got more when you had the earnings yield above the risk-free yield. But when it was negative, like it is now, you still had decent returns. Okay, but we are also looking at really all of those negative returns were in the 1990s. That was the period that culminated with the tech explosion, dot-com bubble, etc. Well, let's take a look a little bit further. What if we didn't measure just a little bit negative or a little bit positive, but we waited until the spread was at least 100 basis points? We're not there right now, by the way. If we waited until that spread was 100 basis points and it was negative, meaning stocks were overvalued, 5 years later, stocks still doubled. If we did it when it was positive, of course, the earnings yield above the risk-free yield. So to me, when looking at this data, having a negative Fed model, right? The risk-free yield is above the earnings yield, is not as strong an indicator as having a very positive. In other words, it may be a great entry indicator to the equity markets, or a time to expand weights or increase weights, but it's not necessarily an exit indicator. And then we say, well, what if it's 200 basis points? And we got the same thing. So you only make a decision on the Fed model at 200 basis points spread. And when the spread was negative, meaning stocks appear overvalued, 5 years later, you still got 100%. And 5 years later, when the market appeared to be undervalued, you got an even bigger return. But in no case was there this negative return. And this is important because in my world, everybody's still talking about this Goldman Sachs report from about a month ago, where they're pointing out the negative relationship, the earnings yield being far below that of the risk-free yield, as it is right now, and suggesting we could get another lost decade. And this compares it to the end of 1999 until the end of 2009. But at the same time, there's so much going on, whether it's parallel computing, quantum computing, artificial intelligence, economic reform, international trade, all of these things we're expecting to happen in the coming years suggest that an exit to equities would be premature. But you've also heard me say over the last couple of months, I think the stock market is overvalued and due for a correction. And I think it is. And if we get that correction, I would be more likely than not to favor increasing equity exposure within the portfolios. Okay. Data this week, we're going to get services, the S&P Global Services and the ISM Services on Monday and Tuesday, respectively. We are still expecting growth in the service sector. We're going to get factory orders, trade deficit, job openings or JOLTS, up a little is the expectation. But because it's the first week of the month, we get the two jobs reports. We'll start with ADP. They're expecting 130,000 jobs. Consumer credit's expected to be 9 billion. Meeting minutes for the December FOMC meeting also on Wednesday. Jobless claims again low on Thursday. Non-farm payrolls and unemployment, we're looking at 153,000 gain and 4.2% or no change in unemployment. We're going to wind the week up with University of Michigan's consumer sentiment reading, which is expected to be basically unchanged at 73.9. The new Congress has been sworn in. That happened on Friday. The results of the election are expected to be confirmed in Congress, the Senate today, January 6th, and then we will move towards hearings on the president's appointees, and then the inauguration on the 20th, and the appointees taking their offices about that time as well. Thanks everybody for tuning in. We like to make the complex and complicated simple and sensical. We're available in all different podcast formats. Most importantly, watch us on YouTube. You get the graphs and charts. And if you could do me a little favor and hit the thumbs up, like, comment, say something positive, it really helps us get more viewers. I'd appreciate it very much. Thanks, and I'll be back to you again next week.